Chapter 6, Variable Costing and Segment Reporting. Hello all. Another chapter with good stuff. This chapter gives you a 2-for-1. We will cover topics related to variable costing income statements and absorption costing income statements, as well as segment reporting. This video focuses on variable costing income statements and absorption costing income statements. These are two different methods for presenting operating results with two different purposes. The variable costing income statement is prepared for internal users and is an excellent tool for decision makers. The absorption costing income statement is required by GAAP for external reporting. As you study this chapter, the must-know include 1. How to calculate product cost under each method. 2. How to prepare an income statement under each method. And 3. How to reconcile the difference between net operating income under each method. We have been using both income statement methods to solve problems in prior chapters, so much of what will be presented has been seen by you. Once you complete this chapter, you need to revisit this slide and study the illustrations. At that point, everything presented here should make sense. If not, then take some time to go over things again. This chapter assumes that you've mastered your cost concepts. For that reason, I've prepared a cost concept review video. The video covers everything shown on this slide plus some. If you feel that a review is needed, I encourage you to watch the video. It's not long and it should add to your level of confidence as you move forward. So let's move on to a discussion of absorption costing and variable costing. Absorption costing, also known as the full costing, GAAP-required, traditional format income statement, is required for all external reporting. Companies don't have a choice here. This method tracks all production costs in the work in process inventory and treats all production costs as product costs. Product costs are attached to the product and are part of the company's inventory until they are sold. In other words, product cost under this method includes direct material, direct labor, and all manufacturing overhead. By this, we mean it includes both variable manufacturing overhead and fixed manufacturing overhead. As far as period costs go, remember that these costs are not attached to the product. These costs are always expensed as incurred. For absorption costing, period costs include SG&A expenses, both fixed and variable. Variable costing, also known as direct costing, marginal costing, contribution format income statement, is a management tool used internally for decision making. Like absorption costing, this method tracks production costs in the work in process inventory. The big difference here is that variable costing defines product costs as direct material plus direct labor plus variable manufacturing overhead. For variable costing, fixed manufacturing overhead is a period cost, not a product cost. The reason being that this cost will be incurred regardless of whether anything is produced or not. So for variable costing, product cost will equal the sum of direct material, direct labor, and variable manufacturing overhead, while period costs include fixed manufacturing overhead, fixed SG&A, and variable SG&A. So let's take what we learned and build some income statements. Check out the Albert Corp data provided. We'll begin by studying absorption costing. Let's first determine product cost. Direct materials at $20 is straightforward. So is direct labor at $30. Variable manufacturing overhead at $10 makes sense as well. All these numbers are given. But why $62.50 for fixed manufacturing overhead? The answer is the absorption costing method determines the fixed manufacturing overhead per unit by spreading the total period cost out based on the number of products produced. In our case, the fixed manufacturing overhead is $75,000 per month. During the month, we produced 1,200 units. So our per unit fixed manufacturing overhead cost must be 75,000 divided by the 1,200 units produced, or $62.50 per unit. Adding the per unit cost for direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead gives us a total product cost of $122.50. Now let's turn to the period costs. The period costs are straightforward. When preparing an absorption costing income statement, only SG&A expenses are period costs. SG&A, as you know, can either be variable or fixed. In our example, variable SG&A are $5 per unit. So total variable SG&A is $5 times the 1,000 units sold, or $5,000. The question might be, why use 1,000 and not 1,200? The answer is because SG&A are incurred as products are sold. They are not part of the production process. The fixed SG&A is $25,000 for the entire month. So we just take that total, add it to the variable SG&A, and get a total period cost of $30,000. We can now prepare the income statement. Sales revenue is going to equal selling price times quantity sold, or in this case, $200 was our selling price. We sold 1,000 units, so we have $200,000 in sales revenue. Our cost of goods sold is $122,500, and that's determined by taking the total product cost of $122.50 and multiplying it by the 1,000 units sold. The gross margin is the difference between the sales revenue and the cost of goods sold, or $77,500. The variable SG&A of $5,000 and fixed SG&A of $25,000 give us a total SG&A of $30,000, which is subtracted from the gross margin of $77,500 to arrive at the net operating income of $47,500. That's it. For financial reporting purposes, our company made $47,500. Note that I use the phrase for financial reporting purposes because the absorption costing method is required by GAAP. The reason being is that the absorption costing method follows the matching principle, which states that companies need to report expenses in the same period as the revenues they help to generate. This means that direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead incurred to produce goods which are sold need to be expensed as cost of goods sold in the periods that the goods are sold. Whatever is not sold remains on a balance sheet as part of inventory. Now let's turn to building a variable costing income statement. The steps are similar, but the results may differ. Our product costs are $60 instead of $122.50. The variable cost method includes only variable product costs when determining total product cost. Fixed manufacturing overhead is treated as a period cost. As such, our period costs total $105,000 and not $30,000. Entering the data into a variable costing income statement gives us sales again of $200,000. Our variable cost of goods sold is $60,000, or $60 times the 1,000 units sold. The variable SG&A is $5,000 again, or $5 times the 1,000 units sold. In the variable costing income statement, we subtract the total variable cost from the sales revenue to get a contribution margin. When we do that, our contribution margin comes out to be $135,000. The contribution margin replaces the gross margin and represents the earnings generated, which will be used to cover all fixed costs and contribute to overall profitability. Fixed costs under variable costing include both the fixed manufacturing overhead and the fixed SG&A cost. The total of these two comes up to $100,000. At this point, we subtract the fixed cost from the contribution margin, and it gives us an NOI of $35,000. Wow, the same data was used, but we got two different answers. The absorption costing NOI was $47,500, while the variable costing NOI is $35,000. Where did the $12,500 go? Well, the answer is it's all about fixed manufacturing overhead cost. The differences result of the cost treatment of fixed manufacturing overhead and the changing levels of inventory. Most companies will see inventory levels change over time. Producing more goods than what is sold will cause inventory balances to increase. Selling more goods than are produced during the period will cause inventory balances to decrease. We have learned that under absorption costing, fixed manufacturing overhead is part of the product cost. As such, the fixed manufacturing overhead associated with products remaining in inventory will be capitalized in inventory and deferred until the product is sold. A deferred cost is a cost that is not expensed until a later time. The time in this case is when the product is sold. As noted earlier, this treatment is consistent with the GAAP matching principle, which requires that firms match expenses incurred with the revenues they help generate. Since variable costing does not include fixed manufacturing overhead as a product cost, all of the fixed manufacturing overhead costs is expensed each period, regardless of any changes in inventory levels. In our case, we produced 1,200 units, but sold 1,000 units. The 200 unit difference represents our inventory. When using absorption costing, the 200 is multiplied by the $62.50 per unit FMOH cost for a total of $12,500. The $12,500 is part of the ending inventory, which will be realized when those units are sold. Since variable costing does not include fixed manufacturing overhead with product cost, all fixed manufacturing overhead are expensed each period. Expensing all FMOH causes the net operating income for variable costing to be $12,500 less than the net operating income for absorption costing. The reconciliation shows that variable costing NOI plus FMOH deferred will equal the absorption costing NOI. So I'm hoping this clears things up a little bit. It'll show you that the difference between these two methods is basically all in fixed manufacturing overhead. Increases in inventory levels will always result in deferred costs for the absorption costing method, and as such will cause the NOI to be greater than the variable costing method. If inventory levels decrease because more goods are sold than produced, then the variable costing net operating income will exceed the absorption costing net operating income as more costs will be released for the absorption costing method than will be expensed using the variable costing method. So which method is right? The answer is both are right. All firms must use the absorption costing method because generally accepted accounting principles requires compliance with the matching principle. Many firms will use the variable costing method as a decision-making tool. The variable costing method is useful for internal management's decision-making purposes. On the other hand, the absorption costing method is useful for creditors and government agencies, suppliers, as well as internal management. The big difference between the two is the decision to use variable costing is in management's court. They may or may not choose to use it. Absorption costing, on the other hand, must be followed to be in compliance with generally accepted accounting principles. This summary and observation slide does exactly what it says it is. It summarizes both the absorption costing method and the variable costing method. It talks about the similarities and differences between the two, how each is prepared and how each is used. I recommend that you pause the video, read each bullet, and make sure that you're comfortable with each of the concepts presented. This last slide focuses on how changes in production and sales affect inventories and how these changes impact the net operating income as determined under both absorption costing and variable costing. Once again, you should pause the video and study the schedule carefully. The bottom line here is that when production equals sales, there is no inventory buildup. And as such, the net operating income for both methods will be the same. Anytime production exceeds sales, we have a buildup of inventory. Because of the buildup, some fixed manufacturing overhead will be deferred under the absorption costing method, resulting in a net operating income which exceeds that of the variable costing method. Whenever sales exceed production, inventory levels will decrease or fall. As this takes place, the absorption costing method will report a net operating income which is less than the variable costing method due to the release of fixed manufacturing overhead costs that had been previously deferred. At this point, you are done. Please take time to look again at slide number 1. Slide number 1 and this final slide should provide you with a clear indication of whether you have learned this stuff. Thanks for watching this video. Once again, it's time to practice. Good luck.